$3 billion. That's the combined value of fines, settlements, and penalties that major banks have paid for precious metals market manipulation over the past decade. Not allegations, settlements, admitted wrongdoing, court documents, Department of Justice prosecutions. JP Morgan alone paid $920 million in 2020 for what prosecutors called a massive years-long scheme to manipulate precious metals markets. And if you think bank trading practices don't affect you personally, I need you to understand what these settlements actually revealed. Because buried in the court documents, in the trader communications, in the DOJ evidence, is a pattern that stretched back decades. A pattern that suppressed the price of the one asset central banks themselves are now accumulating at record pace. The manipulation wasn't secret, it was documented, prosecuted, penalized, and according to multiple indicators, it may finally be breaking down. While you were told that gold was a barbarous relic with no place in modern portfolios, the banks telling you this were trading gold more actively than almost any other asset. While financial advisors steered you toward paper assets, bank trading desks were executing strategies in precious metals markets that would later be deemed criminal. While gold prices stagnated for years despite monetary conditions that historically would have sent them soaring, traders at major institutions were sending messages to each other, describing exactly how they moved prices. These aren't allegations. These are quotes from court documents. "Let's go smash some gold," wrote one trader in communications revealed during prosecution. The Department of Justice didn't call it alleged manipulation. They called it a scheme to defraud. They called it market manipulation. They called it criminal. And now, after decades of suppressed prices, after billions in fines, after criminal convictions of individual traders, something in the gold market appears to be shifting. Central banks are buying at historic rates. Physical demand is straining supply, and prices are behaving differently than they have in decades. The question is whether the manipulation mechanism that operated for 40 years is finally exhausted. Now, let me be absolutely clear about sources before we continue. I'm drawing from Department of Justice press releases, CFTC enforcement actions, court filings from criminal prosecutions, bank settlement agreements, academic research published in peer-reviewed journals, and trading data from the LBMA and COMEX. These aren't conspiracy theories. These are prosecuted crimes, admitted violations, documented in legal proceedings that are public record. What I'm presenting is the pattern that emerges when you connect the documented cases spanning decades, the mechanism that court evidence revealed, and the indicators suggesting this mechanism may be failing. The settlements are public, the trader communications are court exhibits, the fines are paid. The only question is what it means for gold prices going forward. By the end of this video, you'll understand exactly how the gold manipulation scheme operated, what the court documents revealed about its methods, and why multiple indicators suggest the mechanism is breaking down. Because here's what most people don't realize. Gold price suppression wasn't random. It wasn't occasional bad actors. Court evidence revealed systematic practices spanning decades, involving multiple institutions, using specific techniques that prosecutors documented in detail. There's a pattern here, a pattern of intervention at specific times, using specific instruments, targeting specific price levels, exposed through prosecutions that most financial media covered briefly, then forgot. Same techniques across institutions, same timing patterns, same methods documented in case after case. And now the forces that enabled manipulation, paper market leverage, physical supply, central bank policy, appear to be shifting in ways that may make continued suppression unsustainable. The only question is whether you understand what's changing while prices still reflect decades of artificial suppression, or whether you'll recognize the shift only after the repricing has occurred. Stay with me. The next 15 minutes will expose what the prosecutions actually revealed. To understand how gold manipulation operated, you need to understand the structure of modern gold markets, not the simplified version, the actual mechanics that court documents exposed. Gold trades in two parallel markets with fundamentally different characteristics. The physical market, actual gold bars, mined, refined, stored in vaults, limited by physical supply. Approximately 3,000 to 3,500 tons mined globally per year. Total above-ground gold, approximately 200,000 tons accumulated over human history. Physical gold is scarce. Production cannot increase significantly regardless of demand. Supply constraints are real and absolute. The paper market. Futures contracts, options, unallocated accounts, ETF shares, derivatives. Claims on gold that vastly exceed physical supply. The LBMA trades the equivalent of the entire annual mine supply every few days on paper. Paper markets are theoretically unlimited. New contracts can be created without physical backing. Supply constraints are artificial and adjustable. The manipulation mechanism. Court documents revealed how traders exploited this paper-physical gap through several techniques. Spoofing. placing large orders with intent to cancel before execution. Creates false impression of supply or demand, moves price without actual transactions, documented in multiple prosecutions, painting the tape, executing trades at strategic times to set benchmark prices. The London gold fix, conducted twice daily, was particularly vulnerable. Traders coordinated to influence the fixed price, concentrated shorting, overwhelming the market with sell orders during low liquidity periods, Asian trading hours, options. Expiration, key technical levels. Court evidence showed deliberate timing, leverage asymmetry, using futures leverage to control price with minimal capital. A few $1 billion in futures positions can influence a market where physical settlement rarely occurs. Each technique was documented in prosecutions. Each was admitted in settlements. Each operated for years before enforcement actions. Now let me show you the specific cases that exposed this scheme. 3 prosecutions, 3 institutions, same techniques across decades. J.P. Morgan Chase, the largest precious metals manipulation settlement in history. J.P. Morgan paid $920 million to resolve criminal and civil investigations by the Department of Justice, CFTC, and SEC. Not a disputed allegation, a settlement with extensive admitted facts. What did the court documents reveal? The manipulation spanned at least 8 years, from 2008 to 2016. Thousands of instances of spoofing in gold, silver, platinum, and palladium markets. Multiple traders involved, some subsequently convicted criminally. The DOJ called it massive and years long. They called it a scheme to defraud. The technique was specific. Traders would place large orders they intended to cancel, creating false appearance of buying or selling interest. Other market participants would react to the false signals. Prices would move. J.P. Morgan traders would profit from positions on the other side. This wasn't occasional misconduct. Prosecutors documented thousands of instances. The scale implied systematic practice, not rogue individuals. 3 traders were criminally convicted. Michael Nowak, former head of the Precious Metals Desk, was found guilty. Greg Smith, trader, convicted. Jeffrey Ruffo, salesman, convicted. These weren't junior employees, scapegoated for institutional problems. These were senior figures in J.P. Morgan's precious metals operation. The settlement included a deferred prosecution agreement, meaning J.P. Morgan admitted facts sufficient for criminal conviction. They avoided prosecution only by paying fines and implementing compliance changes. And here's what the settlement didn't address. Why? Why would the world's largest bank dedicate resources to manipulating precious metals prices for nearly a decade? The settlement documented the what and the how. The why remained unexplored in official proceedings. But the direction of manipulation offers a clue. The spoofing overwhelmingly pushed prices down, not up. The scheme suppressed gold. It didn't elevate it. Pattern established. Major bank. Systematic suppression. Nearly a decade. Deutsche Bank. The London gold fix confession. Deutsche Bank settled manipulation charges and, crucially, agreed to cooperate with ongoing investigations against other banks. They didn't just pay fines, they provided evidence. The settlement revealed coordination in the London gold fix, the twice-daily benchmark that set gold prices globally for nearly a century. The fix operated through teleconference among a small group of banks. They would propose prices, share order information, and agree on the benchmark. The process was opaque, conducted privately with minimal oversight. Deutsche Bank's cooperation revealed that traders at multiple banks shared information they shouldn't have shared, coordinated positions in ways that influenced benchmark outcomes, used the fix to benefit proprietary trading positions. The communications exposed were damning. Traders discussed pushing prices. They referenced the fix as an opportunity rather than a neutral benchmark. They coordinated across institutions. Following Deutsche Bank's settlement and cooperation, the London gold fix was terminated, replaced by a new mechanism with greater oversight. The century-old institution ended because its manipulation became undeniable. But here's what's crucial. The fix operated for nearly 100 years before prosecution. The manipulation wasn't new. What was new was enforcement. How many years, how many decades, did similar practices operate without consequence? The prosecutions revealed a window, not the full picture. Other banks named in litigation included HSBC, Bank of Nova Scotia, Barclays, and UBS. Not all cases resulted in findings of liability, but the pattern of allegations spanned the industry. Pattern confirmed. Multiple institutions, coordination and benchmark setting, decades of operation before exposure, 2018 to present, the trader conviction wave. Following the major settlements, individual traders faced criminal prosecution. These cases revealed granular detail about how manipulation operated day to day. In 2018, former UBS trader Andre Flotron was acquitted of spoofing charges, but the trial exposed trading practices in detail. Subsequent cases succeeded where Flotron's didn't. In 2019, former Merrill Lynch traders Edward Bases and John Pacilio pleaded guilty to commodities fraud. In 2020, former Bank of America trader Corey Flom pleaded guilty to spoofing in precious metals. In 2022, the JP Morgan convictions established that spoofing in precious metals wasn't occasional rule bending. It was systematic fraud. What the trials revealed was institutional culture. Traders described practices as common knowledge, standard operating procedure, the way business was done. Defense arguments often emphasized that spoofing was widespread, learned behavior, accepted within trading operations. The defense wasn't, "I didn't do it." It was, "Everyone did it." Academic research supported this picture. Studies published in peer-reviewed journals documented statistical anomalies in gold price movements that couldn't be explained by legitimate trading. Research by Professor Rosa Abrantes-Metz found patterns consistent with manipulation around the London fix. The paper attracted significant attention and contributed to regulatory scrutiny. The academic findings preceded prosecutions. Researchers identified suspicious patterns years before enforcement actions confirmed manipulation. The combination of prosecutions, settlements, and academic research establishes that gold price manipulation wasn't theory. It was documented, prosecuted fact. 3 levels of evidence: institutional settlements, individual criminal convictions, academic pattern documentation. The 40-year scheme wasn't hidden, it was proven. Now let me show you why multiple indicators suggest the manipulation mechanism may be breaking down. Indicator 1, physical demand. Overwhelming paper supply. The manipulation mechanism relied on paper markets disconnecting from physical reality. Paper shorts could suppress price because physical delivery was rarely demanded. That dynamic is changing. COMEX delivery requests have increased substantially. Investors who previously accepted cash settlement are demanding physical metal. The paper-physical gap that enabled manipulation is narrowing. When delivery demand exceeds available supply, paper prices must rise to match physical reality. The manipulation mechanism breaks. Central banks buying at historic rates, as documented by the World Gold Council, represents physical demand that doesn't accept paper substitutes. When central banks buy, they want actual gold in their vaults. Indicator 2. Enforcement changed the calculus. Before 2020, manipulation carried minimal consequence. Traders operated for years without prosecution. Institutions faced no meaningful penalties. After $3 billion in settlements and criminal convictions of senior traders, the calculus shifted. Manipulation became career-ending and potentially imprisoning. Banks don't publicly announce they've stopped manipulating. But the enforcement actions created risks that didn't previously exist. The cost-benefit analysis changed. Indicator 3. Price behavior is different. For decades, gold price showed characteristic patterns. Sharp drops during low liquidity periods, resistance at key technical levels, anomalous performance relative to monetary conditions. Recent price action looks different. Gold has reached all-time highs despite a strong dollar, conditions that historically would have suppressed prices. Price moves show less of the characteristic intervention patterns documented in prosecutions. This doesn't prove manipulation has stopped, but price behavior has changed in ways consistent with reduced intervention. Indicator 4, the BRICS factor. Eastern nations building alternative financial infrastructure have different interests than Western banks. When China, Russia, and other nations accumulate gold, they benefit from higher prices. They have no incentive to suppress. Indeed, they benefit from the West selling gold cheaply. The shift in gold holdings from west to east represents a shift in who influences gold markets. Eastern accumulators gain power as Western vault holdings decline. The institutional base that benefited from suppression is shrinking. The institutional base that benefits from appreciation is growing. Indicator 5, paper market stress. COMEX registered gold, the metal available for futures delivery, has fluctuated dramatically. Delivery delays for major vaults have extended. Premiums for physical over paper have persisted. These are symptoms of a paper market straining against physical constraints. The unlimited paper supply that enabled manipulation requires confidence that physical delivery won't be demanded. When that confidence wavers, paper and physical must converge. And since paper is abundant while physical is scarce, convergence means paper prices rising to physical levels. The synthesis. 40 years of manipulation succeeded because physical and paper were disconnected. Enforcement was absent. Eastern demand was minimal. Paper supply was unlimited in practical terms. Each of those conditions is changing or has changed. The manipulation scheme isn't being defeated by regulators or reformers. It's being exhausted by structural shifts that make continued suppression unsustainable. Now, I know what some of you are thinking. Let me address the counter-arguments directly. But the settlements don't prove systemic manipulation. They show isolated bad actors. JP Morgan's scheme operated for at least 8 years. Deutsche Bank's cooperation implicated multiple institutions. The London fix coordination spanned the industry. Isolated actors across multiple banks using identical techniques for decades. The pattern suggests system, not isolation. But if manipulation were real, prices would have reflected it by now. Prices are reflecting it now. Gold reaching all-time highs, despite strong dollar conditions, represents a break from historical patterns. Manipulation suppresses prices while it operates. When manipulation exhausts, prices adjust. The adjustment may be occurring now. But banks wouldn't risk criminal prosecution to manipulate gold. The profits don't justify the risk. Banks did risk prosecution. Traders were convicted. Institutions paid billions. The more relevant question is why. Why did sophisticated institutions accept this risk? Possible answers include supporting short positions, managing derivative exposure, maintaining dollar confidence, or accommodating government interests. The prosecutions documented the manipulation. They didn't explore the motive comprehensively. But gold can be manipulated forever. Nothing forces paper and physical to converge. We've seen this in individual markets. COMEX delivery pressure in 2020 and 2021 created premiums and delays. Scale that dynamic larger, and paper prices must converge with physical reality. Unlimited paper supply works only when delivery isn't demanded. Demand is increasing. But this sounds like conspiracy theory. The Department of Justice doesn't prosecute conspiracy theories. They prosecute crimes. $920 million from J.P. Morgan alone. Criminal convictions of named individuals, documented communications, court evidence. The only conspiracy here is the one prosecutors proved in court. So what does this mean for you? Practically? Specifically? Right now, I'm not a financial advisor. I can't tell you what to do with your money, but I can share what the documented evidence suggests and what historically informed observers consider during transitions. First, understand what the prosecutions revealed. Gold prices for the past 40 years reflected manipulation, not pure supply and demand. The prices you were told represented the market, represented intervention. Any analysis of gold's historical performance must account for documented manipulation. Past performance during suppression may not predict future performance without suppression. Second, recognize the structural shifts occurring. Central bank buying at historic rates. Physical demand testing paper supply. Enforcement changing institutional behavior. Eastern accumulation shifting market power. Each factor points toward reduced manipulation capacity. The structures that enabled 40 years of suppression are weakening. Third, consider what price discovery without manipulation might look like. If gold was suppressed for decades, fair value exceeds suppressed levels. How much? Analysts differ, but the direction, higher without manipulation, is consistent across frameworks. Fourth, understand the physical paper distinction. The manipulation operated through paper markets. Physical gold ownership wasn't affected by spoofing or fixed manipulation. If you're interested in gold, understanding whether you hold physical metal or paper claims matters. Paper claims worked during manipulation. They may behave differently as paper-physical convergence occurs. Fifth, watch the indicators. COMEX delivery data, published regularly. Physical premiums over spot prices. Central bank purchase reports from World Gold Council. Vault holding reports from LBMA and Bank of England. These metrics signal whether the structural shifts I've described are continuing or reversing. If this analysis provided value, subscribe to The Silent Economy and hit the notification bell. I release new research weekly, and the next video breaks down exactly how to evaluate physical versus paper gold exposure, which instruments provide actual metal ownership, and what historical precedent suggests about price behavior during manipulation regime changes. Drop a comment below. Tell me what you think about the gold manipulation evidence, whether you followed the prosecutions, what questions remain unanswered. I rate every comment. This channel grows through engaged discussion with people who recognize that the most important market information often comes from court documents, not financial news. Here's what I want you to remember. The Department of Justice called it a scheme to defraud. They called it market manipulation. They extracted $920 million from J.P. Morgan alone. They secured criminal convictions of senior traders. This isn't theory. This is prosecuted fact. For 40 years, gold prices reflected manipulation. The prosecutions documented techniques. The settlements confirmed practices. The convictions established criminality. Now the structural conditions enabling manipulation are shifting. Physical demand is overwhelming paper supply. Enforcement has created new risks. Eastern accumulation has changed market power distribution. The 40-year scheme may not be ending because anyone chose to end it. It may be ending because it's exhausted. The court documents are public. The settlements are paid. The pattern is exposed. Thanks for watching The Silent Economy. And remember, the people who benefit from market transitions aren't always the ones who trusted manipulated prices. They're the ones who understood the manipulation and positioned for its eventual failure. The evidence is documented, the shift is visible, the choice to understand is yours.